Fund Supermart, your online gateway to unit trusts.
Thank you very much, Song Hui. And as mentioned, his topic was on the return of equities for this year. So the next two presentations are actually on fixed income, starting with the first one with Ms. Diana N. Loon. She is the Senior Product Specialist Director from Allianz Global Investors. She'll be sharing with us her insights about enhancing return opportunities in Asian fixed income. Let's put our hands together to welcome Diana.
Good morning, ladies and gentlemen. First of all, I'd like to wish you all a happy new year, and I hope this year will be a good year for investing for all of us. Now, today I'm going to give you an overview of our view for Asian fixed income markets and talk about two products that I still believe will provide good opportunities for investors that are looking for income. Now, if we start at the beginning of the year, I'm sure many of you are also looking down the crystal ball and see that there are a lot of uncertainties. There's a lot of potential headwinds. And on Wednesday this year, Allianz Global Investors, we held our annual Hong Kong Investment Forum. Now, this is a gathering of all the most senior investment professionals around the world for Allianz Global Investors. We had the global CIO, the global strategist, the global economist, the head of all the respective asset classes. And what I thought was really interesting was one of the polling questions for this group of, in the macro session was, what is the biggest risk for capital markets? Now we have to remember that Allianz Global Investors is a German company, so there was a large representation of European colleagues there. But the result was 42% thought that the Eurozone breakup was the key risk for capital markets. 25% thought a US recession, and 21% thought that a China hard landing was a key risk. So I think what was different this year is that, it's changed a lot. And if we look in terms of the focus for what are the key risks for the markets, and if we look back to this time last year, as Song Hui also alluded to, the key risk that people were thinking about was China, a China hard landing. China growth was slowing. Where there was increasing defaults, increasing leverage in China. People are worried about the renminbi devaluation or depreciation. And this also had ramifications for emerging markets and also for Asian markets. So if I did some marketing at the beginning of last year in Europe, and all the investors in Europe were so negative on emerging markets, they were so negative on Asia, they didn't really want to put anything in Asia, particularly Asian fixed income, particularly given that they felt that the defaults were rising. But if we look at what happened over 2016, what did we see? Asian US dollar credits returned 5.8%. Asian high-yield bonds returned 11.2% last year. Asian local currency bonds, it was mixed because of the currency depreciation at the latter part of the year, but there were some markets that active investors could have captured that generated returns. For example, Indonesian local currency bonds returned 17% last year, and this was one of our key overweights last year that could add value. So what I would say to you is that for Allianz Global Investors on the fixed income side, we're very active managers. We don't, like Song Hui said, we don't fear volatility because it provides us with opportunities, and this is how we invest. So I'd just like to start with our outlook. And one of the key things, the key concerns for markets, of course, is what will happen with Trump. And when Trump was voted as the president on the 8th of November, we saw US dollar rise since then by 4%. We saw US Treasury yields also rise from 1.85% to a peak of 2.6% when the Fed hiked interest rates, and now normalizing to about 2.35%. So what we're looking for this year very carefully, what we need to monitor is when the Fed comes into office on the 20th of January, what his policies will be. Now, the key policies that people are concerned about are his fiscal policies and also his tax cuts, how that is going to impact the budget, and how that will impact on inflation. But I think for Asia, what we will monitor very carefully is what will be the impact of his trade protectionist policies if they are implemented. Now, there is a high chance that, a lot of people, we're a bit worried at this point, but there is a high chance that some of his policies, or most of them, may not be implemented. And with that disappointment, we could see markets turn around, we could see US dollar top, and this could create opportunities on the Asian currency front, which is what we're looking for. In terms of euro, this year politics will definitely dominate. We've got the German presidential elections, we've got elections in the Netherlands, we've got election in France. And I don't think for Asia there's direct impact apart from any negative sentiment that may arise around the election results, for example, like we saw in Brexit. So how we position our funds is in the lead up to the event, we closely monitor how our funds are positioned so that we can try to benefit from the results of the elections. Now for China, this year is the 5-yearly leadership transition year for China. In the past 4 periods of leadership transition year for China, the government has generally kept monetary and fiscal policies accommodative. Now, what this means is we think this year will be no different, and growth stability will be a top policy objective for China. So because of that, we do think the growth outlook is going to be pretty much steady as she goes. And you can see also from our investment survey results that China is less of a concern for investment professionals for this year compared to other more macro concerns such as US and in Europe. And you can see in the line in this chart here, this is the producer price index. This is manufacturer or supply side pricing power. And this has accelerated by 4.3% year on year. Now the bars in this chart show GDP growth, and you can see historically there has been some correlation. So with the producer price index spiking up, whilst we think that we may not see a sharp rise in growth for China, at least we don't expect a hard landing because we do believe that China has a lot of flexibility and policy tools to maintain a stable growth trajectory for this year. In terms of the macro outlook, the key thing we are watching for is what Trump is going to do with his trade protectionist policies, but I would say that in Asia, a lot of Asian economies are embarking on public infrastructure spending this year. China, India, Indonesia, Thailand, and Philippines, they're all embarking in infrastructure spending, and a lot of these have already had funding secured. So this will provide a mitigation to any potential impact of protectionist policies that Trump may put through. And I think that this means that Asian growth will still continue to be stronger than growth in most other regions around the world. It's also important to note that in Asia, there are economies such as Philippines and India where they are less export-driven and much more domestically driven. And these could provide opportunities to diversify for active investors. And also in the Asian outlook, in line with what Song Hui was saying, you can see the Global City Economic Surprise Index, the surprise for economic data is pointing up. So things are looking a bit better for Asia this year compared to last year already. In terms of inflation, now last year, the bars showed the inflation for last year, the year to date as of the end of November, I think. And the orange lines show the central bank policy target. You can see that Asian inflation was pretty much below the central bank policy target last year. So what that means is that inflation hasn't been a problem for Asian economies last year, and we think although there's a reflation theme going on in the US, most Asian economies should not see an aggressive spike in inflation unless we see a large, sharp spike in commodity prices. And because of this, we do expect Asian central banks to remain accommodative generally for this year. Now, what about Asian currencies? Now, the chart on your left shows the Asian dollar index. And this is a trade and liquidity weighted index of the 10 major currencies in Asia. Now, you can see that it's after some sort of period of range trading from 2010, since the taper tantrum period, Asian currencies as on a whole had a downward trend. In the first half of last year, we did see a spike, and for active investors, we were able to capture some of those returns, particularly in Indonesia and Indian markets. But post-Brexit and then post-Trump, we've seen Asian currencies decline again. Now, what is interesting with this chart is that the level of the ADX index is now almost to the level of 2008 during the global financial crisis. And we really believe that Asian economies today are much stronger, that Asian currencies are, at this stage, Asian currencies are now looking much more attractive. Do we think Asian currencies will go back to the Asian financial crisis levels? Absolutely not. And the reason for this is that Asian economies are much stronger. You can see the chart on the right. This is the current account balance, which is one of the key drivers of Asian currencies. You can see in 1997, most Asian economies had current account deficits, and the ones with current account surpluses were the exception. But in 2000, currently, most Asian economies have current account surpluses, and the current account deficit countries are the exceptions. Asia has also built up a much stronger FX reserve balance so that they can much better defend their currencies during periods of crisis. Now, if you look at bond yields, since September last year, you can see that bond yields have spiked. The light blue bars show where yields are in September, and then the dark blue bars in December. So now, Asian credit, represented by Jackie, is about 4.7%. These are Asian dollar bonds. On the high yield side, 6.8%. And in the local currency front, the best yielding markets are India and Indonesia at 7.6%. So the recent move in yields have made, actually, bond yields much more attractive as we start the year. Now, Asian bonds, you have bonds issued by sovereigns, and then we have bonds issued by corporates. And I think for sovereigns, we worry about, as all bonds, we worry about default risk. But I have to say that the 10 major Asian sovereigns today are investment grade rated. The key exception is Indonesia, which is rated investment grade by Moody's and Fitch, but by Standard & Poor's, they're rated BB+. But, so it's split rated. But just last month, Fitch revised their outlook for Indonesia from stable to positive. So there is a potential positive ratings trend there for Indonesia. So I just, the improving fundamentals of Asia over the years have meant that if you invest in Asian sovereigns, you're actually investing in pretty much an investment grade universe. If we look at corporates, this is the Asian investment grade corporates. Fundamentals are generally stable. You can see that net leverage is declining and debt service ratio has improved. On the high yield side though, for high yield corporates, we have seen some deterioration. So if you look at the blue line, this is the overall leverage, and we have seen quite a substantial increase, particularly from Chinese corporates. But if you exclude the property and the commodities corporates, which is represented by the purple line, you can actually see that it's much lower, although the leverage has started to increase as well. This means that security selection is absolutely essential when investing in high-yield corporates. Now, on the right chart, you can see that liquidity, this is liquidity, which is very important for high-yield corporates. And you can see that it still remains relatively ample. This is cash to short-term debt. So Asian corporates generally still have relatively good liquidity, relatively good cash levels, which is a good sign. Now, because of these good fundamentals, the default rate for Asia is still actually expected to remain relatively low. The purple bar shows the default rate that we expect for Asia this year, and it's actually 2%, which is pretty much similar to last year. And this is because most Asian corporates, the fundamentals are stronger, which I showed you on the previous page. Most still have access to funding. And then also the maturity pipeline is not too aggressive this year. That means the bonds that are maturing. Now, if you look on the chart on your right, this shows who is buying the new issues for Asian corporates. And you can see that about 77% of the new issues are actually bought by Asian investors, right? And then the rest by European and US investors. Now, what does that mean? That means that Asian investors, there is less potential for sharp capital outflow in the periods of risk aversion. So, for example, in Latin America, only 10% of their local investors hold their local dollar bonds. And the rest is held by US and Europe and global investors. So when there's a period of macro risk or macro volatility, you see the money go out. But with Asia, Asian fixed income is an asset class for Asian investors. We tend to hold the bonds because we're comfortable with the names, the fundamentals are better. So we have less risk compared to other emerging market regions of capital flight in periods of risk aversion. Now, over the long term, Asian bonds also provide diversification for global bond investors. So this chart here shows how adding Asian bonds to a global bond portfolio can improve your risk-return profile. So this is adding 0% Asian local currency bonds in the global bond portfolio, and 100% here. And you can see that, the sweet spot is 40%, where you're reducing volatility and improving your returns. Similarly, it's a much stronger profile for Asian US dollar bonds. So if you add Asian US dollar bonds to a global bond portfolio, you can increase Asian bonds up to 80% and get an improvement in return and reduction in risk. And this is because Asian bonds still have relatively low correlation compared to global bonds. So, and just a summary, Asian fixed income still provides decent yield pickup compared to developed markets. It remains a stable asset class that provides attractive long-term risk-return profile. And we do believe that volatility creates opportunities for investment managers that have an active approach. And now I'm going to talk to you about two of the products that we believe that can provide good opportunities for income-seeking investors this year. Firstly, the Dynamic Asian High Yield Bond. Now, if you look over the long term, if you look at the yield, this asset class has provided a yield of around 5% to 8% range on average. Currently, we're at about 6.7, 6.8%, so it's at the mid of the range. And our objective with this fund is we want to capture this yield and give you a stable, consistent income-generating yield. Now, if you look over, this is the return of the JP Morgan Asian High Yield Credit Index. You can see that it's been very attractive over the long term. 10-year per annum return has been 8.5%, and with a volatility that's higher of 10.3%. Now, this seems quite high, and this is because this includes the global financial crisis event. If you look over the past 5 years, it's generated 8.8% with a much lower volatility of 5%. So, over the long term, this has been an attractive asset class, but we've had quite substantial periods of drawdowns here. And these drawdowns are quite sharp, and these are the things that a lot of investors are not comfortable with. So what we're trying to do with our fund is we give the portfolio managers flexibilities and tools to try to mitigate some of these significant drawdowns. And the thing with these drawdowns is we've got the sovereign crisis, the European sovereign debt contagion, and also the Tampa tantrums, is that these, apart from actually all three events were related to macro events that weren't emanating from Asia, were they? These were all external events coming from Europe, coming from the US, and Asia just gets hit by the contagion effect. So the good news is, because of that, we're able to manage that. So if you, for example, if you look at the European sovereign crisis event and also the taper tantrum event, Asia corporates did not experience an increase in defaults despite these events, right? So they sold off because of the negative macro contagion, but it didn't mean that the corporate fundamentals of Asian corporates deteriorated that resulted in the default. So what we do with our fund is that in a normal market environment, what we're trying to do is capture the yield, and the yield for bonds comprise, firstly, the risk-free rate, which in this case is the US Treasury, and then we add on the credit spread. And so most of the time, 90% of the time, this is what we want to give you. We want to capture that yield for the fund. But when there is a period of a sharp rise in interest rates, which could be what could happen this year with the Fed on a rate hiking cycle, what we try to do is we use US Treasury futures to hedge away the interest rate risk just for that period where we expect a sharp rise in interest rates. So this is where our active management comes into play. Where there's a period of sharp widening in credit spreads, we have another tool that we can use, which is called a credit default swaps, to also try to hedge away the credit risk. Now, we're not saying that we can capture it every single time and time it exactly, but if we are able to capture part of the move, we are already able to protect some of the downside in the fund. I won't talk about that, but I'll just go straight on to our portfolio positioning. You can see here that the fund has a yield of around 6.5%. We have a relatively short duration of 2.7%. Now, this is important because bonds are very sensitive to rise in yields. So if the US Fed increases interest rates, this can have a negative impact on the bond price. Longer dated bonds tend to have a more impact. So if our duration is low, this means we have lower sensitivity to the rise in US Treasury yields, which is good for the portfolio in a rising interest rate environment. As this is a high yield fund, the average rating is BB-. We have 67 bonds in the fund, and it's predominantly US dollar bonds. Okay, so if you're negative about currencies, you're worried about currency risk, this fund is pretty much all in dollar bonds, so we don't have to worry about currency risk for the fund. Now, in terms of country allocation, China is still the biggest issuer of corporate bonds. So if you're investing in Asian credit, by default, you're going to have a large exposure to China of around 40% for the fund currently. In the past, a lot of that would be China property, but this has changed, and we're starting to see more different types of issuers come to issue. And I would say for this year, as I mentioned earlier, we think that China will have a very stable growth trajectory. So having 42% in China, we're not concerned about, but it's just something to be wary of, or to think about when you're investing in the fund, or to be aware of. I'll just give you an example of one of the bonds in our portfolio. It's called Shritek, and this is an Indonesian credit. It has 50 years of operating history, and it's the largest integrated textile garment producer in Southeast Asia. It actually produces for H&M, for Quicksilver. It produces for Zara, Timberland, one of the big chain stores. It distributes across 55 retailers around the globe, and it employs 15,000 people. Now, it's rated high yield by Moody's and also Fitch, and this is because it still has a fairly high leverage because it's expanding, and it's still coming from a fairly small scale. But this bond offers a coupon of 8.25%, and it's got a very strong customer base that it produces for, like the big names that I mentioned. So we like this bond. We bought it at new issue here at $100 in June, and it's now currently about $103 and still generating a yield of around 6.3%. So these are the types of opportunities that we look for our fund. Now, the Dynamic Asian High Yield Fund is probably for investors that can have a proportion of your portfolio in a higher yielding and more asset class that has more volatility. So it's for investors that can have a higher risk tolerance. Now, if you're not in that camp, the Flexi Asia Bond Fund is another product that may be more suitable for investors that have a lower risk tolerance. Now, Flexi Asia Bond Fund invests across the entire Asian fixed income universe. So we invest in the dollar bonds, we invest in the local currency bonds, we can invest in sovereigns and corporates. And this fund has flexibility to go where we think the best opportunities are. And so if you look at this chart, it shows the returns of Asian investment grade bonds in dark blue, Asian high yield in light blue, and then Asian government in orange across calendar years. And you can see that different fixed income asset classes have performed differently in different market environments. And because of this, we've designed our fund to be flexible. We have no benchmark constraints. We just move across to where we find the best investment opportunities. So at the moment, given that we do see that at least for the first quarter, there's a strong US dollar bias, that US dollar will continue to strengthen, the fund has about 80% exposure to US dollars. But for example, if we feel like that Trump maybe disappoints in its policy implementation in the second half and Asian currencies could strengthen, the fund could go the other way around and invest up to 80% in Asian local currency bonds. So it has a flexible approach to be able to capture the various opportunities in that we find in the market. The yield's about 4.8%, so it's lower than the high yield fund because it has an average investment grade rating. This is what we target, so it's for investors that have a more moderate risk profile. Again, you can see that in the currency, it's now about 90% in dollar bonds, and this is only because we think that there's still a US dollar strengthening bias, but this could very much change, and the fund has the flexibility to rotate to where we find the best opportunities. So I really do think that this is a fund that is a kind of an all-weather fund that can generate income. It's a fund that you can hold for a long term, and you don't have to do the asset allocation across, where you think the best opportunities in the Asian fixed income space, because that's our job and that's what we do. Okay, thank you very much.